Welcome to today's market analysis. Today is July 16th, and I have many items to discuss with you, such as economic indicators, performance of the market, and my views on the remainder of the year, backed by some solid research. And by the way, if you're interested in conducting your own market analysis or dive deeper into the insights that I'm going to share with you today, I'm here to assist you. Contact me on Facebook at Amit Chandan Financial Knowledge or send me a message and I can share with you a comprehensive document that includes all the charts and graphics used in this presentation. Before we get started, let's address a legal disclaimer. This video and its material are not offers to sell securities or provide any investment advice. I am not a certified financial advisor, so please consult one for advice. Throughout the video, I'm going to use various sources, but accuracy cannot be guaranteed. Remember, past performance does not guarantee future results. Investing carries risk, so consider your objectives and seek professional advice. With that said, let's begin. Folks, on July 11, the latest CPI numbers came in, and we received some much awaited news. The CPI numbers for the month of June fell by 0.1%, which was below expectations. And annualized inflation rate reached 3% in June, with the forecast reaching to 2.8% for the end of this quarter, which is September 30th, 2024. Remember, US Federal Reserve wants the inflation to be at 2%. In this quarter, which is the second quarter of 2024, from April to June, the annualized CPI was at 1.1%, which brings the first 6-month CPI to 2.8% when annualized. And we all understand that the US Federal Reserve wants the target to be at 2%, right? But here's the thing. 35% of the CPI figures is shelter. So when you exclude shelter from the annualized inflation rate for the first half of the year, the annualized inflation rate actually turns out to be negative 0.5. That's right. It's a minus. Now, the question is, do we know if the shelter is actually on its way down? And the answer is yes. There is something else in the market called official shelter data. And this consists of rents, which are both from renters, and owner equivalent rent, which means an implied rent that homeowners pay based on the market rents as opposed to their home prices. In June, OER ran the lowest pace in 3 years and close to the pre-pandemic trends. So here it is. This is June. It's at pre-pandemic trends. This gives me the belief that in May, that the May data in our inflation was actually skewed upwards. Now, since shelter comprises 35% of the CPI, we know that the CPI went down in June. But do you know that the shelter data is actually delayed by several months? So in the purple line here, the chart shows a reducing trend of shelter data in the CPI. So as you can see that it's been decreasing, but since it's delayed, you can assume that this decline is also old. Therefore, if we had current shelter data, the CPI would have actually been lower. So that's actually a fantastic news. So based on the recent news of the CPI, the Federal Reserve's chair, Jerome Powell, mentioned that we are seeing signs of deflation again. And this puts Feds in a very tricky spot because their job is to keep the economy stable, right? They control interest rates and they're trying to figure out the best timing for potential cuts. If they cut too early, the borrowing becomes easier and money supply increases. And when that happens, the demand could shoot up, potentially reigniting inflation. And they've worked really hard to control inflation over the last couple of years. But if they wait too long to cut rates, it could keep money supply tight, and this would make it harder to get loans, and investors might hold back their funding of new ventures, which could then slow down economic growth and increase unemployment. So right now, it looks like Fed is warming up to the idea of lowering interest rates. I don't think they're going to lower interest rates in the July FOMC meeting, which is going to happen at the end of this month, but the chances of rate cuts in September seem to be going up. And that is exactly what the Fed Watch tool is indicating to now. So here's the Fed Watch tool. And what I have in front of me is the probability of the Fed's cutting interest rate in September meeting, not in July meeting, but in the September meeting. So currently, as you know, the interest rate is between 525 to 550 basis points. So the probability of it getting cut down by 25 basis points has now shot up to 88.1% to 500 to 525 basis points. And now fast forward to November, there is a potential for another rate cut to 475 to 500 basis points. And that probability currently is sitting at 58.7%. As soon as the June CPI report came out, Treasury yields dropped. The one-year Treasury yield fell from 5% to 4.8%. And the 2-year Treasury yield fell from 4.62% to 4.51%. This shows that the market is expecting Feds to cut rates this year. And remember, we've talked about how the yield of the government bonds and the stock market move in the opposite direction, right? Well, on July 11th, when the CPI numbers looked really good and the bond yields fell, obviously you would expect the stock market to go up, right? But that's not what happened. The stock market did not rise on that day. Instead, it went down. So what's going on? Well, this is going to be a fantastic question, and we're going to have a lot of fun breaking this down. So check this out. When you look at the stock market and its performance on July 11th, some of the biggest declines were in popular companies like Microsoft, Apple, Nvidia, Amazon, Meta. Now, do these companies sound familiar to you? Folks, these are companies that are part of what we were calling last year as the Magnificent Seven, which since last year have done really well. They also happen to be what we call mega cap stocks, which means their market capitalization is just humongous. Now, if you've been holding a diversified portfolio, you might have noticed that it did not do or as well as some of the top stocks that I just mentioned or the S&P 500 index. And that's because over 60% of the gains this year in the S&P 500 came from these 5 superstar companies that I mentioned, which are Nvidia, Apple, Microsoft, Amazon, and Meta. Now, Nvidia was a rock star with its stock soaring 165% this year. And Apple and Microsoft also show strong growth thanks to their innovations. Amazon, Meta were also riding the wave with impressive gains due to their smart strategies. So on July 11th, when CPI numbers were lower than expected, the chances of Fed lowering the interest rates increased and investors got very excited. They started selling their positions in these top 5 superstars and began investing in other stocks, especially the small cap. Now, as a result, the index that measures small cap stocks, which is Russell 2000, also jumped by 3.6%, which is the largest jump it has had since March 2020. Now, why did this happen? You see, investors know that if the interest rates go down, debt becomes cheaper. And smaller companies rely heavily on debt and other forms of cash infusion to survive and grow. So as the chances of money availability increases, these companies have a potential to grow through research and development and recruitment. That's why Russell 2000 went up. Now, I also think that we might see a shift from large cap stocks to mid cap and small cap stocks for the rest of the year. And there are many reasons for that, which I'll discuss a lot more in the future. But a couple of them already discussed. Now, here's the performance of all the sectors up until July 16th, which was yesterday. And you'll notice that technology has done really well. And those of you who have diversified portfolios may not have done as well as the top 5 companies are leading the way, right? Up until June, which is the half of the year, S&P 500 made around 15.3% growth, but 63% of that growth was due to the 5 companies, which I mentioned, Nvidia, Microsoft, Google, Amazon, and Meta. If you removed those companies that had 63% contribution to the S&P 500, then the remaining stock market, which is the S&P 500, folks would have only grown by around 6%. So should you be worried? Absolutely not. This is just how the stock market behaves. Whenever the market goes from a bear market to bull market, only a handful of stocks lead the way. And then comes a time when investors rotate their money from these top companies and distribute to other sectors. And this year, technology sector is being loved the most among all the sectors. And other sectors like financials, consumer cyclicals are not seeing the same kind of love. And it's very possible that the sectors that are in favor this year might not be in favor the next year. So if you have a diversified portfolio and your portfolio is not doing as well as what S&P 500 is doing, it's perfectly fine. Remember, historically, S&P 500 only returns an annualized return of around 10% CAGR, which is compounded annual growth rate. So this year it's been doing much better, but that's not the norm. So if your portfolio, which is diversified, is not doing that well, I won't be too worried as long as you have a selection of great quality companies. And why am I saying this? Do you guys remember what the stock market was like back in 2022? If not, no worries. I have a screenshot from one of my presentations in January 2023 that showed how things were in 2022. The tech sector was out of favor then, dropping by a whopping 31%, right? But I saw at that time a sea of red, as you see here, as a chance to buy stocks of great quality companies that I knew whose valuations were much higher. And I understood that this was a downturn and it was an opportunity for me to enter stocks of those great quality companies and grab those stocks at cheap prices. Fast forward to 2024, which is this year, and we have seen growth driven by the tech sector. But remember, any sector or even tech sector for that matter is not going to remain in favor forever. They're not going to keep growing indefinitely. Now, you must be wondering what I think is going to happen next. So, how do I think the rest of the year is going to look like? Well, folks, as you know, I don't have a crystal ball, but we can look at some historical patterns. And I have a study in front of me that shows the number of times the S&P 500 made all-time highs since 1957 for the first half of the year. So how many years in the first 6 months did the S&P 500 made high? And then the next study is going to show how it performed for the rest of the year. So since 1957, here are different years when the S&P 500 made all-time high. So in 1959, there were over close to 20 all-time highs. In 1964, 65, there were about 43 all-time highs. Fast forward, 95, there were 44 all-time highs. To this year, which is 2024, by the end of June, the stock market had already marked 31 all-time highs, which means 31 times the stock market went to a point which was an all-time high. So based on this trend, how did the market pan out in the history for the remainder of the years? I have a study that shows how the market did for the remainder of years. It shows that for all the times the market did 20 or more all-time highs, in the second half of the year, the stock market for 100% of the time made more all-time highs. So let's break that down. Over the next 3 months, so which is July, August, and September, 66.7% of the time, the market went up by an average of 0.9%. For the rest of the year, the market went up 80% of the time with an average of 5.7%. And if you take the full year return, whenever these things happen, where the first half of the year the market had 20 or more all-time highs, the market went up 100% of the time with an average return of 20%. So if you've heard my previous podcast, I've also said that my belief also is that the market has a potential of rising by 20% this year, if not. The other thing is that this is the election year. So how have the markets behaved in the past during election years? Well, here's a study that shows that in the past 92 years, June has been the best month during election years. So this study has been since 1928 to 2022. But if I narrow that data further, then for the past 73 years, since 1950, this July actually has been the best year. Now, again, these are all probabilities, folks, and no one has a crystal ball. That's why one needs to follow strict investment processes and manage their risks very closely. I hope this was helpful. If you want to get sources of the content that I discussed today, then please connect with me. You can also scan the QR code and connect directly with me through Facebook, is where my group is called Amit Chandan Financial Knowledge. Thank you very much. See you next month.